Okay, traders, here we are. Traders, it's about 3:30. August 31st, last day of summer. Well, not last day of summer, I'm sorry, last day of August. Seems like it's going to be the last day of summer, although it's starting to turn hot and muggy again here in New York today. Today is Wednesday, session 6. Can everybody hear me okay? Can I just get a quick sound check? All right, good stuff. Thank you. All right, guys. Today we're gonna go over. Just gonna review what we went over yesterday real quick, and then we're gonna get into a couple different things today. Number one, we're gonna get into talk a little bit about wholesale retail trade location. Very important factor whenever we're looking to get into a trade is trade location. So we're going to talk about the whole perspective, the whole aspect of wholesale versus retail. And then we're going to spend some time talking about our 4 conditions to enter order flow, to be able to objectively quantify the order flow, the 4 steps, and how we can use that. That's to set our trades up. That's setting the conditions up. Couple that with actual ways that we can use to enter the market. Some entry methods. First thing we're going to do here is update our zones. And this is a little bit more, well, let's update the zones. Well, before we do, so in case this disappears, I wanted to just point out, because this occurs quite frequently throughout the day, and we're always looking for good trade location to get into a trade. Not only the types of trades that are rallying hard, and we're looking for a spot where that value transition is going to take place, where that up auction is going to turn into a down auction. So we get into the trade, we work it starts to go into our direction. We get this value transition. So in other words, we're playing up here. Maybe we have a zone. Maybe we have an inventory transition. We start working some shorts. The market transitions. We're able to take inventory off. We have opportunities to put it back on if we want to. Value transition type of entry, selling the uptick. But there's also more aggressive, maybe more advanced strategy. And I just wanted to point it out to you guys that although I don't talk a lot about it, because again it's maybe a little bit more advanced, but there are plenty of opportunities once the market starts to head in our direction. In this case, we're selling the market on the uptick. We get the transition. Now we can continue to play it to the short side as long as order flow is confirming, of course. So I'm taking this kind of out of context, but I'm saying let's make believe order flow is giving us the green light. As we were talking about earlier with Joseph's question, we get the green light to start looking for shorts, and we're looking for an excuse to play it to the short side. We have a combination of different factors in effect, and we're just looking for that short-term confirmation as the final step before we enter a trade. One of the things we could look for, especially as the market moves a little bit further in our direction, is the pullback, the uptick back into previous value. This is temporary retail. Well, this is the closest level of retail value up here, right? And here's what it looked like. I put an arrow on it as I saw it occurring, so I wanted to make note of it. But as this zone forms, the market sells off. We have value up here. Now we could split this out. It's a pretty big zone up here, so let's split it out first things first. Okay, so we have a zone up here. And that would be this zone right here. Let's get rid of the dome, of ending the day. Very, very lackluster morning. We had some good opportunities throughout the afternoon. There was a few opportunities we talked about we didn't take, but as usual, every day, as sometimes it takes an hour or two in the morning for the market to give us levels to play off of. But as usual, as the day goes on, the opportunities are there, guys, throughout the day, every day. There's never need to force it. There's always more than enough to go around. For the most part, we'll encounter days throughout the year where the volatility is totally dead, and you'll see days where the whole day is maybe only a 6 point range, and we'll still find opportunity on those days, but the opportunity won't be as abundant as it is on a day like today. But today there was more opportunity than really one trader can handle. So there's no reason to force it in the morning, and sometimes it's hard to, the morning trade room, we have a lot of visitors in there, and they're coming to see us trade, but still, I'm not going to force any trades unless I see opportunity. It might not be apparent to them, they're not familiar with our methodology. You guys know, you see every day that there are opportunities every day, and we're just looking at one market here. So it's just silly to ever put yourself in that position where you feel the pressure that you have to get into a trade. There's never that pressure, ever. So here's the spot we're looking at right here. I'm trying to just reacquaint myself with, okay, let me get rid of a couple of these spots. The market had just gone through a few inventory levels, right? Took out a zone, found support off underlying zone in here, and we're starting to get this relief rally here. Again, we took out our demand levels, right? We had some inventory transition occur. We had that supply vacuum, so now you're getting the snapback rally. Aggressive traders, if they got long, they got out of their trades, could be looking for spots to reverse to play a move to the downside. Where's the first logical spot to do that? Well, in the next highest level of value that just formed, and using that zone on the pullback. Now, you can already get a sense here that this short inventory is not covering. You see a pretty rapid, intense move here of over 5 points to the upside. Short inventory is pretty much staying pat. You have a few people covering out of their positions, but for the most part, you see a nice level of commitment there. And look at on this final pop up. You can see the inventory did not even rise on this pop up, and when it popped up, where did it go into? It went right up into the previous zone. Okay, so another question that people are new to our methodology, visitors in the morning, are you always looking to fade the trend? Are you looking to get with an existing trend? I mean, those questions are all relative to the context, right? At one point, we were selling against the trend, but as the move starts to develop in our favor and we can use opportunities to sell these upticks, then really we're selling with the trend now, right? You're selling here, you're selling with the trend. And if you ever get to the point in your own trading where you get into some deeper type of swing trades, you're going to be looking to put your inventory on, take it off after a nice deep swing. You're looking for an excuse to start putting it back on here as it comes back up into previous value, newly formed value. New push down, you're looking to take your inventory off. New lows on the day, market pops up, you want to put inventory back on. This is the location you're looking to put it back on, and here. Again, as long as the order flow is giving you this confirmation. But these are the things you're going to start to put together. Hey, you know what? I see these shorts aren't covering out. They're staying committed. I can see that. It's very obvious. Where's the next logical place for me to put on a trade? Where is it going to be the hardest for the market to get through? Think about it in those terms. Well, it's going to be very hard for the market to get through a retail value area if there's no demand coming into the market. That's what it comes down to, guys. You think about the market in these terms. But let's update all of our profiles here. We just broke through this zone. Took out this demand level. And Pretty much every level that was in here gave nice tradable opportunities off of. I think there was one minor level in here that got maybe this level right here. Actually, the market reacted here off of it, right here. But you get a sense where you can get into the rhythm, right? Like Joseph was saying before, you notice that yeah, the market would make a pop, and at that time the market was rallying. It would make a pop to the upside, hit the stops, and then fall back in again. All right, same thing here, but only it's to the downside, right? It would make a new pop to new lows, run the stops at that little mini inventory transition level. Where would it go? It would go right into or very close to the next zone. Logical place for us to look for a long, right? The market's running out of supply. How's it going to get through that demand zone? It's going to be hard. Market pops up. They reload the shorts. Got some selling pressure coming in. The market breaks through the previous zone, and where does it head? It goes down, runs some stops from longs. It stops right at the next zone. So we get into that rhythm. Stops run, get long at the zone. Pop up, take off the inventory. The market pops to a new low, runs the new stops that are in the market. Once those guys are done crying uncle, as the market's coming into the next zone, looking for a long, and here you got this nice little short covering rally here into the close. That's the rhythm, that's the flow of the market, guys, and it's, you know, I describe it almost like, you know, you could think of it as waves at the beach, or you're getting on a ride, you know, and you're looking for spots to get on the ride and off the ride. You know, the market's constantly moving whether you're on it or not, but we're looking for these high probability spots, trying to get with the flow, trying to get in the sync of the market's always going pretty much back and forth. The vast majority of the time, it's going back and forth, back and forth. And that back and forth motion is just caused by people getting stopped out of trades. So sometimes you get on the ride and the market goes a little bit beyond you. Like this morning, right when we opened up the afternoon trade room, I had a trade where we had to cycle some inventory. You know, the market went a little bit beyond us. Fine. We don't panic. We talked about it ahead of time. We planned it out that it was a nice, really wide zone there. There was a couple of inventory levels. We let the market go by us, let the stops get hit, and we looked to put on additional inventory. Just kind of going with the flow of the market. You know, there wasn't an exact level. There wasn't a whole degree of accuracy with the process. There wasn't any red light, green light indicator telling us to get long or take profit or let our stops get hit. You know, we get in, go with the flow of the market, but we're watching the real-time order flow as it develops. So important, guys. It's almost like, you know, once in a while, you know, when I say I'm probing, I really am probing. Sometimes it's a matter of, all right, let me put the position on here. It's in a good spot. Let me put a small position on here. Let me start probing and monitor the market for a continuation or price improvement in my direction. See if I could start to get in the groove of any type of transition occurring in my direction. So let's update new zones here. We have a nice zone up in here. Supply. Let's split this out over here. Really wide zone in here. Let's see if we could split it out again. Into the cash close here, the market's popping up. I don't think we're going to be able to do much about the wideness of this swing zone down here. There's just not enough activity here, so we'll encompass this. We're going to make this, actually it's not even that bad of a zone, 8.5, it's 3 points, not that bad. But what we're doing is also we're encompassing some imbalance here. You see this imbalance here, guys? This profile opened up, closed. This profile opened, the market shot down. imbalance, demand imbalance came into the picture, the market shot up pretty intensely here to the upside with this short covering rally, right? Not going to do anything with this much right now. This is kind of an anomaly, kind of thin, elongated profile. Couple obvious low volume spots in here, but we're at the close. We're close to the close. We're not trading anymore here today. Let's just let it play out, and then we'll update that zone after the close. Do the zones make sense to everybody here, guys? Are there any questions about zones in particular? You know, guys should really be at the point where, you know, your zones don't have to match up exactly with mine, but I want you to be at the point where you understand what I'm doing with the zones, how I'm coming up with them. You know, a few of you guys like to ask me questions, like if my zone is a little bit different than yours or you don't understand, I encourage that. Please do. Let me know if you have a question about anything at any time, of course, but particularly about a zone. If I put a zone up there and you don't understand it or it's not matching up with your zone, let's talk about it. But, you know, this is one of our organizing principles in our methodology, determining where these zones are. And guys, you see day in, day out how the market reacts at these zones. Very important to us. Let's update. Oh, let's bring this forward here. Let's update a few of our inventory levels here. These are the levels I'm going to key in on overnight, not only for inventory transition, but commitment. You know, if we get a continued pop overnight up into, especially if we can get upper reaches of this zone, perhaps into the bottom of this zone, and yet shorts are staying committed to their position, we don't see them peeling off their inventory, it's going to set up some good short scalps there overnight. Same token, if we get a drop down to test this demand level, maybe to fill out some of this unfinished business in here, we should have some good long scalps setting up here to the long side overnight. The market stays right here in the middle, just rotating, well, then there's not going to be much opportunity tonight. That's okay too. I think all these levels are updated. Let's get rid of these. I don't even know what these lines are doing here. Right up into this zone here, guys. Nice little reaction there. Not a whole heck of a lot of clues from order flow. We wouldn't be trading here anyway due to the time of the day, 5 minutes away from the cash close, but you know, another good healthy reaction off the bottom of a demand zone. Alright guys, so inventory is updated. Any questions on inventory levels at all? Let me know. Alright, let's just do a quick review about stuff we went over yesterday. You know, yesterday we spent a good portion of the session reviewing what we learned the week before with order flow and zones, so we're not going to rehash that again right now. Again, I encourage you, last night's video was posted up there, but any questions on zones in particular, or any areas you feel like you want to spend more time learning about, refer back to those videos, guys. And if there's anybody that at this point has not been able to access those videos, please let me know. Everybody should have a password. and username and access to those videos. So last night's video is up. And tonight's video, of course, after we complete it, it'll be uploaded and put onto the site later tonight. All right, guys. Tick and breath. We got into both of these charts yesterday. Any particular questions, any specific questions about tick in general, how we use it, what we're looking for? Remember, we're not really using tick to get into a trade. Although you could, but you know, that's not what I'm looking for. It's not going to keep me out of a trade because tick is, you know, it's actually going to be showing a lot of times at the time that we enter during an inventory transition. Tick is actually going to look like it's acting detrimental to what our position would be. In other words, if we're looking to short the market, or let's take this as we're looking to get long into the market in the face of an inventory transition. You know, they just took out some levels here. We're getting long. Well, tick at that point in time is probably going to be running some heavy-duty sell programs. They need to run those sell programs in order to run these stops, right? In order to squeeze out the longs, they have to put on the sell pressure. That's why we're not really paying attention. If you're looking at tick all the time when you're about to get into a trade and you see a bunch of sell programs going off, it's going to probably influence you, at least to a small degree, and either make you hesitate or maybe not even put on the trade. So that's why I say I don't look at tick when I'm about to put on a trade. It really doesn't do me much good. The way that I best have found to use tick and utilize tick is once I'm in the trade, to use it to either start taking off inventory quickly or maybe hold on for a few more ticks. You know, I want to see tick acting in a way that is beneficial to my position at that point once I get into it. You know, if I get long in the market, inventory transitions occurred, I don't want to see continued sell programs because that probably means they're trying to get more sell stops below where I just got in, which isn't necessarily the end of the world. But if I could see that quick enough and at least shed a portion of my inventory and look to pick it up at lower levels, that's going to be beneficial to me. Does that make sense, guys? How we use tick in that fashion? You know, more so to manage our trade. Looking for confirmation. We get into a trade. We get long. Well, we get long. A minute or two goes by. We really don't want to see sell programs running off one after another. You know, we want to see the buy pressure. We don't necessarily have to see a buy program, but it would be beneficial to our position to see at least some buy pressure coming into the picture. The tick basically just measuring stocks that are in uptick versus stocks that are down ticking. The other thing that we look at, breadth. Some days for the whole day, I might not gain a single piece of information from breadth. You know, the market might just be in lockstep with breadth. But there are days where breadth will show you some information. And again, it's not one of these things that I'm staring at all day long. I'll be glancing at it. It's on my screen, one of my other screens. I'm glancing at it. And I want to look for discrepancies. I want to look for divergences. I want to see breadth rallying, futures selling off into a demand zone with other order flow conditions supporting along. That's the type of stuff that I want to see. And again, that's not going to get me into the trade so much. It's just an additional confirming factor that once I get in the trade, maybe I'm going to hold on for a few more ticks because I see breadth is you know, there's a lot of underlying strength in the market, and that's what the breadth represents. Underlying strength or underlying weakness. You know, is S&P is making a higher high in price, but yet breadth is making a lower high? Well, that's telling you the cash market is not supporting the strength of the futures move. You know, the futures could have rallied, could have popped just to run some stops, but yet the cash market is not supporting with underlying strength. Very important information to us. Okay, guys, there's the cash close. Market got back up into the mean of the range. And again, no real outside influence today after the news came out. In fact, seems like we've traveled a great distance today, right? But yet, look where the market opened up right here, guys. They popped up, ran some sell stops, took it down, ran buy stops of short traders, took it down to run sell stops from long traders, and right back up into the middle, right where it opened up. So at the end of the day, nothing's really changed, Once that news came out at 10 o'clock, I guess it really wasn't that much didn't have that much influence on the market, and the market just came right back into the range. And most days, this is the type of action that we see, this rotational activity, right? At the end of the day, if we looked at a daily bar chart, you might see the market make a little bit of a higher high, but yet spent a lot of time within the range of yesterday's trading, right? And within the range of overnight trading. We tend to lose sight of that fact sometimes if we get too concentrated on the foreground. Another important fact about the tick, just important to realize with the cash market and the futures market, the majority of the time the cash market is going to run these buy and sell programs and pressure the futures market. They're going to lead the futures market around on a string the majority of the time. When we have these battles, we had one this morning where it looked like S&P short traders were trying to stay committed to their positions, but yet the cash market kept hammering them with these buy programs, keeping the pressure on. It was the futures traders who wound up relenting and crying uncle. Important to remember that, guys. All right, let's talk today about. Going to talk about the perspective, more about our landscape, about thinking about the market in terms of wholesale, retail, and then we're going to look at those 4 steps. But remember what we're looking at here, guys, before we get specifically into wholesale retail. But bigger picture, this has to do with wholesale retail, our playing field, our landscape. That's what we use our profile chart for, to maintain that broader perspective, not only on where are the important zones from today, where are the important zones from overnight, where are the important zones from yesterday and previous days. This chart allows us ultimately to prepare all of our if-then scenarios, be aware of important areas in the market of imbalance, unfinished business, the context. Again, today earlier this morning, Joseph pointed out when we were talking about this zone that the fact that the zone was occurring at the high of the day. This is part of the context. If we're not looking at this and we're only looking at the foreground, we really don't have any way of knowing that, right? Because we're not looking at enough time on our chart to see that. But when we keep glancing back to this 60-minute profile, it becomes a lot more apparent where you are on the playing field. Very important context, guys. Using these profiles to form our market map allows us to project forward from a sound base, to see a contrast from all this vertical movement that's occurring in the foreground, right? If you're looking at just this slice here, you're like, wow, the market looks real bearish here today, Put this in the context of this, and you say, hey, you know what? The market's just smack dab back in the middle of the range where we opened up, So all in all, pretty neutral, if not leaning towards the upside, right? Because we closed yesterday at 04. So very important to keep this longer time frame perspective. And instead of getting caught up in the excitement of the moment of what's occurring on the foreground chart. And that's what most retail traders are fixated on. All this activity with no regard to where supply and demand is. Market's selling off, they want to be short because it's moving to the downside with no idea that the market's coming into a demand zone, no idea that we just had an inventory transition and they might have just sold a low of the day. You know, night and day perspective, guys. You know, we're able to distinguish between what conditions provide opportunity and what conditions produce random noise. You know, and a lot of times you'll see me miss trades. Sometimes purposely I'm saying, listen, I'm not trading anymore, but this looks like a good opportunity. Other times you'll see me miss a trade because I'm waiting for a little bit better trade location. You know, but in the end, you see that it pays off. You know, and it's rare that I get into a situation where I'm taking a lot of heat. I mean, I'll get into trades where I'm taking heat, but it's rare that I'm getting into a position where I'm going to take a lot of heat on a single position because I'm really looking for a good trade location. Not to say that it doesn't happen, because it happens every once in a while, and anything can happen at any time. But for the most part, we're really risk averse. Right? Always have our eye on risk. Now, we're going to talk for a minute about the smart money, and then we'll kind of use that to segue into wholesale retail. But smart money traders who we're trying to emulate, you know, the big boys, they need to place their orders. They have no choice. You and I, it's more of a want thing. We're not forced to do business unless we want to. This is a major edge in itself. Another one besides our own edge of, you know, reading the order flow and determining where the zones are. But think about what this means. We get to watch the big boys push their money around, but we don't need to get involved until we know the hand. That's a pretty big edge, guys. Use that to your advantage. Can't stress that enough. You know, we want to emulate the smart money, but we don't always have to be getting involved as often as they are. We can wait for the cream of the crop. We can wait for that money that's lying there in the corner. And the more experience you have, the more time you spend with us, you're going to know, if you don't already know exactly what I mean now, you will realize what I mean and you'll experience it yourself. But, you know, aligning ourselves with the strong hands, taking the opposite side of the weak hands. You know, that's a big part of trading. You know, identifying these areas. Another big part is identifying these zones, these areas where a significant number of traders are going to feel compelled to take action. That's as they're getting stopped out. And a lot of times, if we're looking to get short, where is this action occurring where we're going to have a lot of capitulation take place? It's going to be taking place in retail areas of the market, right? Retail locations, retail value. So you got to start to put together that aspect of looking at the market in terms of wholesale retail. You know that if you want to be a seller, you got to be selling at retail prices. You're going to be selling in a retail zone. A lot of times, as you're selling in that retail zone, whether you realize it or not, you're getting in on the heels of a bunch of shorts getting stopped out. And usually misinformed retail traders getting long into a previous retail zone, right? A lot of retail traders in here, besides the guys that are getting stopped out, you have some guys getting long into here. Meanwhile, we're waiting here to get short in retail value. Okay, so thinking about these terms, these areas in the market in different terms, but there's different things going on that complement each other. Yeah, it's retail pricing that we're getting here, but you also have to realize that this is the zone where the hurt is being put on the short traders, guys that got short in here and can't take the heat anymore. This is where they capitulate. See this intense movement here? This is shorts capitulating. Believe me, guys, I promise you, if you can achieve this on a consistent basis, you've got the order flow edge. And you'll learn as time goes on ways to extract the most profit that you feel you can from the market. You know, whether it's with additional size, whether it's becoming more active. There was an area today where my microphone went mute on one of the trades, but it was one zone, one area where I think I had three three separate trade sequences in a row to the long side. So I extracted extra profit out of this same general area by becoming active. Every time the market came back down into the area, made a new low by a little bit, I was looking to get long as the inventory transition was occurring. All right, guys, so knowing what zones of price the hurt is going to be put on the weaker hands, retail, wholesale. Another really important thing to discuss, and we're going to talk about this more tomorrow, trade management, but how we use our trade location to control risk. And again, we're going to get into that a little bit further tomorrow with trade management and talking about how we manage our trades instead of with the financial control, more on a market-based control. What the market is doing, market-derived information. And we're also tomorrow going to get into our ag factor, our aggression factor. But as far as wholesale retail levels, guys, and besides our zones, we have this filter here. And it's just a very visual filter. It's not something you hear me talk about a lot, but you'll notice that a lot of the times when I'm getting into trades, for the most part, it's going to be when the market's coming into these levels. Right? The market is at the edge of the relative price move that just occurred. I'm looking to get long. This is confirming that I truly have wholesale pricing. Wholesale pricing, wholesale pricing. This is retail pricing. And you'll notice how often the market reacts near these levels. It's not any type of indicator on itself. Again, it's just more of a confirming factor for us. Just a way for us to quickly see just how much of a wholesale level we have. Now, that's not to say that we can't get involved in the market if the market is not hitting our channel. Okay, a good example was that trade that I pointed out before. Where was that pullback? Was it here? I think it was in here actually. Yeah. This was the pullback where I had the arrow. We pulled back into the previous zone. If you notice where that was, it wasn't at true retail levels. It wasn't hitting the channel, but we're aware of that. We're aware that we're selling a zone within a down move. We're using that uptick. We're basing it on the order flow commitment that we had at that time right here. As long as you're aware of the context, guys, and you're aware that, we're maybe selling in the middle here of the range on this uptick, but we're not selling wholesale prices. Right? That's the main thing. We don't ever want to be selling after a period of selling. In fact, what do we do here? We would be looking to sell after a period of buying. This was not a rinky-dink 1 or 2 point move off the lows. This was almost an 8-point rally off the lows, 7 points at least, 7 and change. It's just that this move is so overextended. This was a 16, 17 point move to the downside. That this move didn't bring us back into true retail levels, but still a very tradable trade. And again, context. Be aware, guys. Be aware that this is the type of trade you got to be nimble. If you get in here and the market starts to pull right through you, like the zone you just got in was butter, then you don't want to be in anymore. You want to just get out, because you don't want to hold this all the way to the edge, all the way to the other side. So, smart money traders, the guys that we want to emulate, the guys that we want to become, simply buy at demand levels, wholesale levels, and sell at supply levels, retail levels, over and over and over again. We're trading with the smart money and against the retail traders when we're buying at wholesale prices and selling at higher retail prices. It's that simple. Just repeat this process over and over and over again. And think about it, that's why we call them retail traders, because they buy at retail prices. And when we're buying and selling anything in life outside of the trading, outside of the markets, we're trying to buy at wholesale prices and sell at retail, right? Homes, cars, a jar of peanut butter at Walmart, whatever the case may be. We're looking for things on sale, below value, if we can get it below value. You know, you go into a dealership to buy a car, you don't want to pay sticker price, because you know you can get it lower. You can know you can negotiate. You're looking to buy a home, odds are, unless you're really, really in love with the house, you're not going to pay the asking price. You're going to counter offer. You don't want to buy at the ask price. You want to buy at your price, at the bid. Same thing with trading, wholesale, retail. It's just when buying and selling in the markets, the same people that'll go haggle at the car dealership or haggle with and negotiate with the person they're buying a house from, when it comes to the market, they don't try and haggle. They don't try and negotiate. They're perfectly willing to pay retail prices because they get involved in the heat of the moment, the vertical development. They see this thing selling off. Oh, we got to get short. You know, this thing is, it's going to make new lows here. Let me buy it. Let me sell this breakout. They're trading based on emotions, fear, and greed. Excuse me, guys. And that's the reason, you know, the average trader never considers looking at the markets in the way we do, is because they're making their decisions emotionally, not objectively. And let me tell you something, this illusion and misconception, miscalculation of retail traders is single-handedly responsible for the massive and never-ending transfer of money from weak retail traders to smart money traders into the accounts of those who understand wholesale retail. And think about that for a second. You know, different retail traders all looking to sell this move at the lows, basing it on emotions, basing it on price-based indicators that finally, after the move occurs, telling them to sell. But they're all selling in the wrong location. They're selling at retail prices. And like we talk about all the time, can the market continue to go down here? Yeah, of course, anything can happen. But it's not expected that it would go down from there. In fact, it's expected that it's going to head the other way, because once those stops are run, the market's going to pop back up. That's what we expect to happen with a certain degree of probability. Right? So you know, 1 time out of 5 that the market does continue to head to the downside, maybe they'll make money. But it's not going to be enough for the other 4 times that they lost money on it. They got stopped out. So it's a losing play. It's a losing, it's a negative expected value play, which means over time they're not going to make money with it. There's no value in trading that way. So simply put, how you buy and sell things in every other part of your life, cars, homes, grocery shopping, it's exactly how you should be buying and selling in the markets. And if you miss a trade, you're trying to buy wholesale and now the market's rallied and it's near retail pricing, oh well, you missed it. Look to buy the pullback to wholesale or wait for the next setup. You know, so essentially, we're looking to buy wholesale value, wholesale value in a market whose bias is up. All right, we're looking to sell retail in the market, in a market whose bias is down, and that bias could be, you know, we're talking about our bias, not the bias that's on CNBC or any other bias. We're talking about our bias, depending on the order flow. All right, so whether we're selling up here or we're waiting for the value transition and then selling here once the immediate bias is more apparent, you know, we have more confirmation. Either way, we're looking to sell wholesale. All right, we're looking to sell the zone that was here wholesale on a higher time frame. I'm sorry, retail. Looking to sell retail. All right. Listen, guys, we know the market consists of multiple agendas. Smart money in all different time frames, including longer time frame participants who are interested in bidding the market up to higher retail levels. Our goal is to buy this pullback into wholesale value right here, right here, right? This pullback into this area, or into value that we have here. We're buying this pullback, looking for this pop up. We go along for the ride, guys. We get on, and we're counting on probabilities. We're counting on the smart money. We're counting on our knowledge that we're buying in the areas that they're buying, and they have an agenda, and their agenda at that point, once they're long, is to move the market up. So basically, we're going along for the ride, selling at retail and banking the profit. That simple principle, guys, has worked for centuries. Every market you could think of, before organized exchange markets, rice markets in Japan, centuries ago. Every market since the beginning of time. And once you understand these principles and the principles of analyzing the real-time order flow, you have an edge. You can't dispute that. Maybe you don't understand all the intricacies or the different nuances of how you're going to manage a trade or where exactly you're going to enter it. That's fine. You're going to get to that point where that stuff becomes apparent as well. But right now, you guys are developing your edge. Your longer term students, you already have an edge. Your newest students, you're developing that foundation of an edge. That's what you got to be concentrating on, guys. Just understanding the stuff we're talking about. Don't worry so much yet about putting it all together. There's just such a simple elegance to this whole process, the way that we've broken down the markets and this perspective. It doesn't get much appreciation because it's never discussed. Because retail traders don't know about this type of stuff. They don't think about the market in this aspect. Brokers don't talk about the market in these terms. In fact, 95% of traders and anybody involved with the markets don't think about the markets with this perspective, and that's why 95% of traders lose consistently. It's going to start to become more and more evident to you. Not only evident as far as what you should be doing in a particular situation, but evident on the next level deeper. Take it a step further beyond the mechanics, beyond the ability to recognize the patterns. It should be evident on a level of understanding of what's actually going on. Hold on one second, guys. Just checking out a different market here. All right, guys. So, just put that together with the fact that, the market is, it's just continually moving and probing, getting back to acceptance and rejection. It's constantly trying to find wholesale value, retail value, but also constantly just testing to make sure there's no more supply below the market, making sure there's no more demand above the market. Where is it going to test for that? In these reaches of wholesale value zones, right? That's where they're going to test. If they can't get through those wholesale value zones because there's no more selling down there, the market's going to bounce there. Think about all the traders that are involved on different time frames. market reacts, an economic report comes out, and it's barely received by the market, for instance. This activates the short time frame players, the shorter time smart money, the market makers, the floor traders, the guys that operate in the middle of the range, and they want to take it down to the first perceived wholesale value area, so they can start to buy. They'll take it down there, run the stops, and look to buy, whether they're buying to cover shorts or buying to initiate longs. They still want to do their buying in wholesale locations, so they're driving it lower into that area of wholesale value. There's a whole process. We see these tests and retests. A lot of times you'll see the push down into value. Stops are getting hit. No divergence. And then you get that pop up. And then on that retest is when you start to get the divergence. You see that there's no more sellers down there. You got the longer term players now stepping in, waiting to see if the market's going to sell down further, waiting for a second thrust down. And if there is a second thrust down, which happens quite frequently, even if they're just thrusting it down to take out that previous low by a tick or two, and they see there's no interested sellers at those prices, they can't run any more stops, now the longer term players get more interested there. And they express that interest by moving size into the market with buy orders, market orders to buy. We got to break things down constantly, guys, in this manner. And then, it gets to the point where you're not thinking about that stuff anymore. You know it's happening, but you don't have to stop and think about it. Right now, you're breaking everything down and thinking about things piece by piece. But I'm telling you, you're going to get to a point where you're just flowing with the market. And it just becomes self-evident what you're supposed to do. And even if that means what you're supposed to do is nothing, that's going to be evident too. There's going to become a time you're comfortable trading, you're trading consistently profitable, but there'll be a time in the market where you're just not sure what's going on. You hear me say that. There's no opportunity here. I'm not really sure what's going on here. Okay, that's becoming self-evident too. It becomes self-evident to you that there's nothing to do there. Just stand aside. Moments where you can't quantify the order flow, where things are confusing, where you just can't put a handle on what's going on, just stand aside. Doesn't mean you're doing something wrong. Different story now when you first start learning, because it might not be clear to you. It will be natural to be confused because you don't understand everything. But I'm talking about as time goes on, there'll be points where you're confused. That's telling you to just stay out of the market. So that's, you got to think about what you're doing here, guys. You're running a retail trading business. From your office, from your house, wherever you're trading from. Just like a Walmart or a Costco, a Sam's Club. Huge operations that make fortunes. And what's their secret? Well, at the end of the day, they've simply mastered the art of buying at wholesale and selling at retail. Right? And their actions of buying and selling in the markets that they operate in are no different than the actions of profitable traders that operate in the markets that we operate in. You know what the difference is? We can do this from our own house, our own office, when we want. We open and close our business whenever we want. We can open business for an hour and shut it down. Walmart has to always hum along with this big business. They don't decide, of course they close at night and they open up in the morning, but for the most part, they're open the majority of the time. Just like a casino. And I don't mean to compare trading to gambling, although a lot of traders, that's what they're doing, they're gambling, but we're taking the role of the casino. We pick and choose when we want to trade. We're waiting for the odds to be in our favor. So it's not really a wholesale retail example, it's more of a probabilities example, and we'll talk more about that tomorrow. But we've got elements of different successful businesses in what we do, but yet we have so much more control than they do. We get to pick and choose when we want to do business, when we want to take trades. Huge edge, guys. You gotta use that to your advantage. So, when we're looking to buy and sell at a higher price, we're looking to buy at wholesale. Our goal is to get that price driven up to retail levels and find willing buyers. Well, we don't really have to do that. We don't have to drive the price up. The smart money's going to do that, right? Because we're getting along in the same area that they're getting along in. So we're really essentially just riding their coattails by emulating what they're doing. Does this make sense to everybody, guys? Wholesale, retail? I mean, it's pretty logical. I know it's easy to understand. It's just a matter, you know what it is? It's that, and I speak from experience. I know I never stopped to think about the markets in this manner. But once you start to think about the markets like this, you can hardly believe that you ever traded without thinking about the markets like this. And it starts to become much more realistic that, hey, you know what, it always, until I got to the point that I was profitable, I felt like there had to be a way for me to get there, but on one hand, it seems sort of like a pipe dream, like, how am I going to get this, Once you start looking at the markets in these terms, it becomes a lot more realistic. You break it down logically. Because there are people that make money trading. You have to, when it comes down to it, you have to figure out what they're doing and emulate them. That's what we do. We become smart money, guys. So let's talk about these 4 steps. I just want to make sure everybody understands these steps. These are how we quantify the order flow, quantify supply and demand, quantify opportunity in the market. First thing I always do, guys, and everybody has access to this, it's on the website in the toolbox. First thing I always do, I want to always look and see where is my next zone in relation to where the market is now. It's never a matter of looking at the market and trying to figure out where it's going. I don't care. Unless I'm in a trade, I really have no preference. The only preference would be if we're more closer to a short inventory level than we are to a long inventory, well, then I would probably prefer we head up there so I can find an opportunity quicker. That's my only preference. Otherwise, I don't care whether we head to the downside, head to the upside. We'll trade either way all day long. Doesn't matter to us. So I never put that pressure on myself. I don't get into that ego trip of trying to predict where the market's going and where it's going to turn and how many points is it going to move before it turns. That's what retail traders do. But step 1, where is our zone? Where's the next area in the market that we're interested in doing business? We see the market now. Where are we? Popped up. Overextended into our zone. If we were here and we're looking for the next zone, we know ahead of time we're going to look to be shorting in here. So step 1, always be looking where you are in relation, where the market is in relation to the next zone. Well, as the market moves near or into the zone, and even beforehand, you could start to think about what you want to see happen with the order flow to confirm that. Is the market going to be close to an inventory level? Odds are when it gets into that next zone, we're going to have an inventory transition. So that's what you're going to be keying in on at that point. You know where your zone is. Now you're keying in on that inventory transition. Or if the market gets up to the zone, instead of A, instead of the inventory transition, you'll see B, you'll see commitment, right? Because we can't have commitment and an inventory transition at the same time on the same chart. Right? Does that make sense, guys? If price is selling off, let's say price in the next few hours sells down close to the 1200 level, but inventory stays up here, maybe ticks down a little bit, but we have a divergence, we have a commitment. It's telling us longs are staying committed to their position. We can't have that occur at the same time as the inventory transition occurring, right? Because if this inventory headed down with price, as price sells off, the inventory sells off into an inventory transition, then we wouldn't have the commitment, right? So it's either A or B. Now, sometimes what you'll notice, guys, and this is a little bit more advanced, but you'll notice this, sometimes you'll have an inventory transitioning happening on the higher time frame, which might take a few minutes to play out. And in the midst of that, you'll start to see commitment on the shorter time frame, which is a great clue, because now you have an inventory transition to take along, because longs were just stopped out, there's no more supply. Now you're seeing new longs come into the market, and as price comes down to test that previous low, now the new longs are staying committed. So now you'll have a divergence in the face of an inventory transition on the higher time frame. Does that make sense, guys? I know that could be a little confusing. Any questions, just let me know. I know that there's got to be some questions. Somebody's got to have a question about that. Alright, guys, so inventory transition, so number one is zone, inventory transition, or divergence on the inventory charts 1 and 3. But both things, either separately or together, as the market's coming into a zone, will set up an opportunity. On one hand, if the market's rallying into a previous area of supply, and now you have an inventory transition where shorts are getting stopped out, and now there's no more demand coming into the market, how's the market going to get through this supply zone if there's no more demand coming into the market? That's option 2A. 2B, with divergence, let's say the market is coming up into a zone, but we're seeing divergence in the inventory here and or here. Again, as the market's coming into a previous area of supply, this is an area where sell orders prove themselves to be previously. This is retail pricing. Smart money sells retail. Now, knowing that, now we see in the real-time order flow there's commitment, there's divergence. How's the market going to get through this zone? It's going to be very difficult, right? If the smart money's committed and they're not buying in here, and in fact they're committed to the shorts here, their short inventory, how's the market going to get through this area of supply? We're not going to say it's impossible, it's just highly unlikely. That's what we're banking on. We're banking on this rotation. It's simple, guys. It's that simple. I mean, technically, really, that's all you really need, if you think about it. You know, we have other filters, we have other ways to help you pull the trigger with the stair-step entry and fishing with limit orders and stuff like that. But when it comes to trading, that's basically what you're waiting for, the market to come into a zone, either having a transition, inventory transition, or showing commitment of the smart money. These next two steps or levels of confirmation are really just extra, and they increase your odds. Don't get me wrong, you're stacking the odds a little bit further in your favor, but don't think that you always need them. Okay, looking at the real-time buy pressure, sell pressure for divergence. Now, sometimes you might not be in an area of a true inventory transition. like right here, right? Let's scroll back here. It's a good example in here as the market, I mean, this isn't the perfect example, but you get the idea. As the market's coming up into this zone showing divergence, you're not truly at an inventory transition here. You're a little bit shy of it. But you could start to work a short position here. You see that there's less buy pressure here. And again, this isn't even the best example. You know that we had better examples. Here's a better example right here, actually. Market coming into a zone here. You see there's less sell pressure in here than there was here. It's obvious. Going to be hard for the market to get through there at that point in time. You know, even though we might not technically be at an inventory transition point, even though we might not show divergence here, it's still high odds for a bounce there. Now, do you have to take these type of trades? No, you don't have to if you don't want to. You can wait for the inventory transition or the commitment, the divergence. Or you could take it a step further and say, you know what, I want to trade where it's coming in. It's always got to be at or near a zone. I have an inventory transition or commitment, and I have divergence here. Now, appreciate how much further you're stacking the odds at that point. So that would be step 3. And again, we always want to have step 1. We always want to be in a zone. We always want to be aware of step 2. We always want to know where the inventory level is. If it's not in a pure transition point, okay, maybe I'm not there, but I know it's not too far off. It's right above me, and I can start probing here as long as I have some divergence in the buy pressure, sell pressure. Or I could say, you know what, let me just wait for the inventory transition to occur or the commitment. You could wait for textbook. Step 4 is really just an extra visual confirmation. We talked about this before. Just confirming that we are at wholesale or retail pricing levels at or near, or if we're not, just to be aware of it, because it might cause you to manage your trade a little bit differently. But that's an additional filter. You could wait for just pure wholesale pricing all the time. You could become very picky. You really can. And sometimes you see me get into that mode where I really wait for high opportunity type of situations. That's going to be up to you. You know, in the beginning, obviously I'm going to recommend you wait for the more confirmation that you can get, the better. But eventually you'll learn to start managing your inventory and say, all right, you know what, I'm not quite at an inventory transition point, but I'm coming into a zone. I have divergence on the buy pressure, sell pressure. Let me start to probe here with a small position, knowing that my inventory transition is a little bit above that, but I'm going to work some additional inventory above there if I take heat, and start to probe into your position that way. But initially, you're going to wait for the more important type of conditions to be in effect. Does that make sense, everybody? Four steps. All right, let's talk about one particular way to enter. You know, and guys, we need to realize that this is not mechanical, but by using a stair-step entry, we could introduce a little bit of an element of a mechanical aspect to it. These steps are located on the website in the toolbox. log in here and show you exactly where it is. Once you're logged in, guys, even if you shut your browser, you should still remain logged in. But if you restart your computer, you're definitely gonna have to log back in. And you just go to the members toolbox, and then again, the chat rooms are separate. You might have the same login information. Some of you do, some of you don't. You still have to log into the chat room separately. The toolbox, once you're logged into the site, will bring you right into the toolbox. You see all the videos here. Again, just to review every video right now. We're going to change this password soon. In the next few days, we'll let you know. Right now it's supply. For every single video, it's supply. Charts, we're going to start to put some charts in here. Here are the files. Each of these leads to a file, a PDF file. This is actually a screenshot, but this is a PDF file right here. 4 steps in confirming order flow. Just hit it, and it'll come up on your screen there. And we have more notes actually to upload over here too. But you know, it's starting to fill up here with. There's a lot of good material on here, guys, to keep you busy, to give you homework, to study. You know, and a lot of these videos, I mean, if you're looking at this video and you just want to get into the order flow, you know, realize that the first 15-20 minutes of every video is kind of a review of the previous day, a review of zones. If you want to fast forward and just get to the meat of it, that's perfectly fine, you know. But let's just talk about the stair step entry real quick. And the opportunity to use the stair step entry is best. The video password is supply, SUPPLY. The area that we want to use the stair step entry is always going to be at the edge. No problem, guys. It's always going to be at the edge. And the edge is a relative term. You know, it's relative to what we're looking at, but at the edge, after the market's sold off, it's coming into a demand zone. After the market rallies, coming up into a supply zone with divergence. That's when we're going to use the stair step entry. But what it does for you, it gives you a quick visual reference. Let me go back to this example here that we used before. Let me recreate this. Pull back here. I think it was right in here. Right in here. Alright, good. This is the pullback that we talked about before when we started the session. A little bit more aggressive type of entry, but we have a zone. You know, the trend has already transitioned to the downside. We have a zone. The market sells off more, but you know, we're still bearish here. We see breadth selling off, sell programs going off. We want to look to sell this uptick, but it's not enough that it's coming into the zone. We want to see a confirmation of commitment in the order flow, right? We definitely get that here. We could see the market popping up pretty intensely, but yet order flow is hardly moving, right? So how do we actually enter that? Well, one of the ways we can enter that trade is with a stair step entry, right? So here we are, the market's coming up into our zone. We see the commitment here. The stair step entry tells us that once, you know, the market's like a rubber band, and it can only get extended so far, especially coming into a previous area of supply into resistance. The commitment here, in other words, the shorts are not covering their trades. In fact, they're looks like they're actually adding inventory. What we're looking for here is for the previous bar's low to be taken out. That's a stair step entry. And what that does for us, it's giving us the first visual confirmation on the lowest time frame level that we have a sell response, right? Two elements of every change in direction. Number one, the first element, we need demand to die. But the second element is we need supply to come in. We need that sell response. So that's what the stair step entry does for you. It's very visual. It shows you you could be bringing up your sell stop here now. Okay, you could say, okay, if we break this level, and it's hard for me to figure out exactly what this is. Looks like 15 and a quarter. So if it breaks 15 and a quarter, I want to be short. All right. It goes up again. You notice how it doesn't take up. Okay, now if it breaks 15 and a half, previous low, I want to be short because I know I want to start to get short in here. But yet I want to wait for a little visual confirmation. I want to see that sell response. And it's a little bit more mechanical. You notice I really don't use this entry method, but some especially newer students find it helpful. Helps you pull the trigger. Okay, so now you'd bring your sell stop up and you could just move it right up on the dome. Right? You just drag it. You had a sell stop here below 15 and a quarter. Now your sell stops 15 and a half or below. You just drag it up. Okay, now your sell stop gets, this bar is ended. Right now your sell stop's up at about 16. Now it gets taken out. And you get in at 15 and 3/4, but now you're short. All right, that was the first time the sell stop would have got elected. That was the stair step entry. The first time the previous bar's low was taken out. A little bit easier if I spread it out. All right, just play around with that, guys. You know, see the market come into a zone. One of those 4 steps, or all of those 4 steps in effect. And we'll talk about other ways to handle entries in here tomorrow. But just think about that as one of the ways that you can get yourself to enter the market. Stair step entry. It's not something we could use when the market's in the middle of a range, because when the market's range bound, let's find an area in the market where we're range bound, you see that the market is just kind of taking out pretty much every previous bar's low, every previous bar's high, because it's just rotating, right? It's no good there. We're not trying to use it there, but we are trying to use it at times when the market gets into a zone and is overextended. Now, one drawback with this entry method, guys, let's get back to that right here. One drawback is you're giving up a little bit on trade location. Now this one happens to be not too bad. But what happened if this bar came all the way back down and took out this low? Well, you would have got short 15 and a half, 15 and a quarter. Not the best trade location in the world. So you're giving up trade location, ideal trade location, instead of getting short up in here in the middle of the zone. You're getting short at the bottom of the zone. So you're giving up trade location. But in turn, for giving that trade location up, you're getting some confirmation. Right? You're getting an additional level of confirmation. That additional level of confirmation is the sell response. All right, so instead of just hopping in front of this upward movement here, and we're not just indiscriminately picking a spot. Obviously, we're in the middle of a zone, perfectly okay to do this, and you see me do this all the time. In fact, this is how I like to enter on the uptick if I can. But again, if you're looking for that additional confirmation, this is the way that you're going to get it. The sell response. You're in the market right here. You know, think about the market as a rubber band. It's overextended at this point. It's overextended. It's in an area of previous supply. And you have commitment of shorts. They're not giving up on their inventory. They're not bailing out as the market is pulling up against them. So the market is becoming like a rubber band. It's rapidly being stretched. Right? So as soon as a little bit of that pressure comes off, the market's more often than not will come snapping back. Alright guys, so print out, I mean if you haven't already, print out those 4 steps. And seriously guys, I mean, you know, we have more to talk about tomorrow, the next day, every day in the trade room, how we can fine tune all the different aspects and perspectives that we learn about order flow. But those 4 steps, that's the foundation of what we do, guys. Get comfortable. Number 1, with identifying the zones. Number 2, with inventory levels, inventory transition levels. And at that point, start to look at the other stuff. Well, right here, you could see relative to how far price pulled back. Order flow didn't pull back as much here. You know, I mean, price pulled back almost 7 points. Pretty deep pullback. One way to visually index it is just to snap a line on here. Index the same 2 levels, and you see how far back price pulled compared to how far back order flow pulled. So all of this short inventory stayed committed. No problem, Jay. Yeah, I mean, you know, sometimes it just takes me saying something a different way, or hearing me say something the 3rd or 4th time. That's why you realize a lot of what we talk about a lot of the same stuff, you know, over and over again. It's repetition. But this is showing you commitment. So as these guys are staying committed, and very important, as it's coming into a zone, very important, it's coming into this previous area of supply where we know sell orders were. It's going to be hard for the market to get through this area when this condition is in effect. I'm not saying that it can't, but we're talking about probabilities. Odds are, if these guys are staying short, they're expecting lower prices, at least at that moment in time. All right, guys, I'm going to end the recording here.